Hello and welcome to 2025. We're already 2 weeks into the new year, and you've probably seen a few predictions or what a lot of people think will happen in the housing market, both nationally and locally. Um, so I wanted to put together a presentation with what I'm hearing and seeing, and so let's jump into it. And there are some good reasons to be optimistic for 2025. All right, so here are the forecasts right off the bat. And these are not mine. I did not come up with these myself. These are from Barry Habib at MBS Highway. He is one of the most highly regarded and respected and accurate forecasters in the mortgage and real estate industry. So I trust him as much as I trust anyone. But just like any forecast is never 100% accurate, take these with a grain of salt. You can spend some time online and come up with a whole bunch of differing opinions to these, but like I said, I trust him as much as anyone. So, mortgage rates decline to 5.75% or 6%. They're currently at about 7, even a little higher this week, or I guess today and yesterday have not been kind to mortgage rates. So we are currently even above 7% in a lot of cases. That's on a conventional fixed rate 30-year mortgage. And then below, these are the factors that could play into mortgage rate movement throughout the year. So inflation is a big thing. When rates first shot up so high, that was the big talking point. Like, what's inflation going to do? We need to get inflation down. It has been coming down, which is good. And it's expected to continue that trend, to get down right around 2.2%. And of course, that helps interest rates come down as well. Unemployment rate. So the unemployment rate is the big talking point currently and probably will be going forward throughout the year. There's a lot of differing opinions on the unemployment rate. And Barry Habib, his opinion is that the current unemployment rates are not accurately reflecting the true scenario. So he thinks the unemployment rate will actually go up to 4.6%. It's currently at about 4.2. I'm not going to get too deep into that, but basically the unemployment rate, that's good news for mortgage rates, because higher unemployment is, the better mortgage rates tend to be. And yeah, so that's where we're at with unemployment. Fed funds rate down another 4 or 5 quarter basis point or quarter percent cuts. Again, this is one person, one company's opinion. Currently, the Fed is not that optimistic, but this is tied to the unemployment rate where, again, it may be higher than it really is. And not that we're rooting for people to lose their jobs, but that would help interest rates. And then home price appreciation holds steady at about 4%. And this is all nationally. From a national perspective. Towards the end of this, I will have a bit of a more local view at Utah, but those are the forecasts. Now I'm going to dive a little bit deeper into each one of those, just a little bit. So here's a graph of inflation. So the orange is the mortgage rate, the average 30-year rate versus inflation. So what is optimistic here, or what's good news, is you can see there's always this margin between the two. And it trails, the mortgage rate trails a little bit, right? It took a while for rates to spike as inflation was increasing. But now inflation's down, and we haven't really seen the benefits of that yet. And so that is encouraging that this year we may start to see rates dip following this trend of inflation a little bit better. So that's what we can look forward to as far as inflation is concerned, assuming that it stays or continues to drop throughout the year. All right, let's talk about unemployment rate. All these things are tied together, right? They all impact each other, and it's kind of this loop where unemployment can affect monetary policy and what the Fed decides to do, which in turn can affect inflation and then into mortgage rates. So it's kind of this loop. But generally speaking, when unemployment is higher, economic policy tends to drop interest rates to stimulate economic activity. And then a tight labor market can lead to greater risk of inflation, which again can lead to higher interest rates. Um, there's a lot of reasons that some people think that the labor market is weaker than what's currently being reported. So the gig economy is a big thing, right? People doing, I don't know, Uber or food delivery services or any of these things that are kind of freelance positions. So somebody may report that they're employed working in one of those gig economy jobs, but that's very different than a stable 9 to 5 salaried position or something like that. And there's still a large population that is underemployed. Technically, they may have jobs, but they are still underemployed. So those are the reasons in a nutshell why unemployment may actually go up this year. And when we say go up, it's the opinion of Barry Habib that the reports will finally match reality. It's not that things are going to get a lot worse, but the reporting will kind of catch up. And once that happens, that will then feed lower interest rates. All right, let's talk about the Fed funds rate. So this year, you can see so this is the COVID years, right, where it was dropped to like nothing. Then the big hike over the next year plus. Then we've held steady, and now we finally started to see some rate cuts mid-2024. But the interesting thing, so the thing to remember is the Fed funds rate does not directly correlate to mortgages. You can see that. And if we pick out, specific areas, you can even see for a while here, it's hiking, but we had a drop, right? And then you can see, well, hang on. I mean, you could pick any point and see that the trend doesn't follow. Like here is stable, rates dropped, right? And then now we're going to zoom in on the past few years, kind of this area. And you can see again, doesn't match. Look at all this stability, right? And we had all sorts of movement going on. And what's interesting right now is we're actually seeing a complete opposite effect where the Fed has cut rates and mortgage rates have gone higher. So the Fed fund rate is the rate that banks lend money to each other. It's not directly tied to mortgages, and that's where we see all this volatility. So one reason for this going up is every time the Federal Reserve Committee meets, they take kind of a survey and they put it on this dot plot, what we're seeing here. So this was not the most recent Fed meeting, but the one previous to that in September. So each of these dots represents a committee member for each year. So there was, at the time this was taken, there was still one more Fed meeting to be had. So each committee member basically cast a vote and said this is where we think the rate's going to be at the end of the year. So you can see, the committee members thinking what's going to happen, whether they're going to do another cut, keep it stable, or raise it, and then same for each year, right? So they're basically voting where they think is most likely that the Fed funds rate will end up at the end of that year. So what's interesting is we compare this September 2024 and we overlay the December dot plot, and you can see the movement up. So the purple means it's overlapping. The red means it's December 2024. So any movement where it's more red heavy up here means the committee members are changing their opinion to move higher. They're thinking the rate will end up higher than it really is. So you can see the consensus for the end of 2025 moved up quite a bit. Where it was down here, it's shifted up. And then every year you see more red and purple towards the top, more blue towards the bottom, which means opinions are shifting up a little bit. So this is actually in contradiction to what Barry Habib thinks. And again, he's kind of banking on that employment report that they will end up correcting and doing more rate cuts once the employment reports are more accurate or reflect reality more closely. So that's interesting there. But mortgage rates will move quite a bit on opinions and speculation, as well as hard data and reports. So when the Fed comes out and says, actually, we might not cut rates as much as we previously thought, that affects mortgage rates. Because mortgage rates will always act in anticipation of what actually happens. They don't wait for the actual data, the actual report. It'll change just based on opinion and future projections. Okay, let's talk about the housing market a little bit. So now this is Utah specific. So what we're seeing here are housing units built and households added, new households created. So whether that's people moving in from other states or growing up, getting married, starting a family together, forming a housing unit or a household. And so anytime these bars differ, this gap here is basically creating a shortage in housing units that are available. So you can see from 2010 all the way to 2018, there were these gaps, right? More households created than housing units built. And then during the COVID, pre-COVID and through the COVID years, we were catching up. You know, builders were going crazy, interest rates were low, lots of demand for housing. But now the past couple of years, we're right back to that shortage with higher interest rates and with home price appreciation getting high. Same thing, but in a table form, so we can actually see this cumulative shortage, how it piles up. So we got all the way to 56,000 and then all the way back down to 28,000. And then now it's anticipated that we're going to be adding to that shortage through the next year. So what does that mean for the housing market? So that means that there's going to continue to be a demand for housing in Utah. When I started doing mortgages in 2018, I heard, and I've heard it since, that I'm waiting for the housing market to crash. Since 2018, it definitely has not. Quite the opposite. And this is the reason why it will not crash anytime soon. There's just too much demand. There's too many people that want to buy a house and not enough houses available. That doesn't mean that there's 37,000 people homeless, right? Or households of people living on the street. It just means that they're living with family. They're living together. Instead of having their own home, they're, you know, getting roommates and sharing housing costs. And so until the housing units catch up with the demand, values are going to stay about the same. We're not going to see a crash in the housing market as far as prices are concerned. All right, last little point here, the demographics of home buyers. I find this interesting. You know, if you're a real estate agent looking at your potential client base, or you do fall into one of these demographics looking to buy a house, this is interesting. Just who is the potential home buyer, the biggest potential home buyer group. So this just shows the estimated population, and this is nationwide. So we're back at a nationwide scale. Home ownership rate, so how many own a home, and then the potential buyers, so what's left over after the 65%. So in the baby boomer generation, there's still 24.5 million that are not homeowners. And that's for various reasons. You know, this generation is aging and maybe they're selling homes, living with family, or other long-term care needs, things like that. Some, of course, in all these demographics will never be homeowners. That there's always a percentage that will never either choose to do that, or due to their circumstances never be able to do that. So again, when I started millennials, that we heard all about millennials and how many homes they would be buying in the next 5 to 10 years, and it's still a huge percentage. There's still 41 million potential home buyer millennials, but now Gen Z is the next home buyer generation. They're at about 24% home ownership right now, which still leaves over 50 million potential buyers. So anyway, thought that was pretty interesting. That about wraps up this presentation. If you do have any other questions about whatever I talked about, feel free to get in touch. We're really plugged into this and keeping track of everything throughout all of 2025 with interest rates and the market. So use us as a resource. Reach out, let us know. Whether you have clients that need help or you are a potential home buyer or know somebody that is a potential home buyer and wants to buy a house in 2025, let us know. Always happy to help. Thanks.